Markets have been sent tumbling. Inflation came in hotter than expected. And you might be wondering why when you opened up your portfolio were some stocks down by 5, 10, 15%. Today we're going to talk about all of this. We'll unpack the inflation numbers, but it's also a much broader discussion. We're going to talk about forecasts and where the current market forecasts sit, but also why forecasts are not the best to be relied upon and how we should be viewing the markets moving forward. It's a fascinating discussion. We'll look at where the experts currently have market positioning pinned at, and then I'd love to know your thoughts, so drop in a comment below. And before we get into it, make sure you've subscribed and turn your bell notifications on so you won't miss many of our market updates. To start off, to frame the discussion, why are forecasts impossible to predict? Of course, if you go back to any time period, to any event or situation, you'll see forecasts. There's always divergent opinions. Some will come pretty close to the mark. Some will miss the mark completely. And those are often held up on Twitter or online as relics of the past. However, the reality is nobody can forecast anything with 100% certainty. And there's a range of different reasons for that. When I used to work in management consulting, the team I worked in was fairly quantitative modeling heavy. And there was this quote that was often discussed. It says that all models are wrong, but some models are useful. And essentially, the way we have to understand it is that all models just utilize base inputs, arbitrary numbers and assumptions to help to us extrapolate in a straight line out as to where things currently may end up heading. But of course, we know that markets and any situation in life is dynamic. It's not going to just evolve in a straight line. New things can pop up. New scenarios can evolve. And of course, things that we thought might occur may not happen. And so today we're going to think about markets with this lens. Of course, nobody knows exactly where things are going to head. However, everybody's able to forecast about where that potentially things might head if different assumptions come to light. So what are the key questions that we're currently thinking about from a market angle? Of course, inflation, first and foremost. We know that interest rises flow out of that. The discussion surrounding earnings and valuations. Growth. What happens if they keep raising rates? Will they be able to navigate the soft landing, or are they going to send us into a recession? And then, of course, geopolitics. These are some of the questions, and nobody has the answers, but it makes sense for us to understand the key questions so that as the situations evolve, we're able to update our own personal forecasts and our own assumptions, which might give us a bit of a guide about where we think things may head from here moving forward. First up, the key question, inflation. We just had the hotly anticipated August U.S CPI numbers. Forecast consensus was 8.1%. We came in slightly hotter than anticipated, 8.3%. CPI on the core inflation side rose as well, 6.3%, hotter than anticipated. And there was a few market jitters, to say the least. Actually, we saw the market down by 4% on the S&P 500. The growth year-end focused NASDAQ was down by over 5%. It was a big sell-off, one of the biggest in recent memory. And the real question that the market has is, okay, when's the Fed pivot going to come? I think by now we've realized the Fed put is dead. The Fed pivot is not going to come anytime soon. And the Federal Reserve members have been making that evidently and abundantly clear, stating that we're going to continue to keep raising rates. Inflation's that focused mandate that we have right now, and we will keep going until we get inflation under control. So the question is, with such a steadfast focus with that, how far will they raise rates until something breaks? And of course, we know that the economy and economic data, that is obviously an insight into the past. However, monetary policy operates with a lag time. So we might be raising into weakness. And what is going to happen when something does break? So that's the big question that we've got on the inflation and the interest rate side. How quickly will inflation come down? Obviously, there's supply side pressures, but also demand side pressures. And as the Fed raises rates to try and quell that demand, what's that going to do to the economy and growth over the longer run? Then on the other side is earnings. We all know that we had a market sell-off to start off this year. However, predominantly that was focused on the price side of the equation. Of course, we know that valuations has two different components on the price and the earnings side. Valuations were stretched. Prices have started to become quite exuberant, and we saw them come down. However, we haven't seen a significant earnings revisions yet. So far, earnings have been resilient. We saw a lot of companies exercising pricing power. Yes, there are inflationary pressures on the cost side, but with earnings so far, mostly they've been able to be passed on to consumers without too much of a reduction in demand. However, there's a lot of questions about what happens as earnings start to come down, as rates start rising, and we start to see a slowdown in the economy. And this piece from Mike Wilson, the chief US equity strategist and the chief investment officer from Morgan Stanley, was quite a fascinating one. So he stated that margin expectations for 2023 appear overly optimistic as cost pressures remain sticky and demand slows. The combination of sustained higher wage costs and slowing end market/consumer pricing has been evident in recent macro data and loudly signals margin pressure. And this is a view that's shared from a range of different forecasters. On the other side, obviously flowing into that, the earnings slowdown potentially many people think is going to come as a result of that impending recession and the growth slowdown. Just a couple of these images here give you a bit of an insight into the divergent opinions that we have. On one side, this is a funny cartoon that I'm sure some of you have seen. It's got the U.S. Federal Reserve trying to, stop inflation or look after the big beast that inflation is. But this cartoon suggesting that maybe the tools they have aren't big enough to pull it in. But then on the other side, there's been discussions from prominent figures such as Elon Musk or Cathie Wood recently about the fact that, yes, we're currently fighting inflation in the near term, but is deflation the real risk on the horizon that we're not yet paying attention to? Of course, this is a question of, can we navigate the soft landing? Can we restrict and inhibit inflation quickly enough that it doesn't get out of control, but in a well done enough manner that it doesn't rapidly affect the economic recovery that we've seen and hopefully send us into a recession or not too deep of a recession? There's a lot of questions, and really what's important to understand is nobody's going to have any direct certainty about where this heads. But over time, we're going to get more data inputs and data points that will enable us to make a more informed decision. But this is really that soft landing question, one of the key ones coming through. And then geopolitics. We saw over this past period, Russian troops retreated from the east after a counteroffensive. Of course, it's not only the Ukrainian situation. There's situations around the world. Geopolitics uncertainty is occurring. We're seeing a decoupling of economies on some different levels as well. And so we know that geopolitics has the ability, of course, if things go wrong or unravel, to be a big shock to the market. We saw it happen earlier this year with the Ukrainian situation. But also if there is a positive resolution on that front, first and foremost, we're hoping in terms of for individuals and for safety, a positive resolution, but further to that as well, it could provide some support on the market side too. But at this stage, uncertainties do continue on the geopolitics front. And so where does that leave us in terms of price targets itself? As we know, at the end of the day, the markets are a balance of probabilities. First and foremost, if you've enjoyed this video, don't forget to hit the like button and make sure you've subscribed and turn your bell notifications on as well. But the markets are a balance of probabilities, and these probabilities are weighted to each individual investor or fund based on their worldview and the way that they're perceiving the current market conditions. Everybody's going to have different probabilities about the outcomes that may potentially occur. But what's important is that we do the work, we do the research, and we spend our time understanding the space so that we can have the most informed probabilities. Of course, everything still is uncertain. This time more than ever is leading to a range of different uncertainties. As you can see here, we've got the most recent price targets. It's worth noting these came out before the inflation print. So of course, they may be revised now with that hotter than anticipated print. But you can see here the range of outcomes. We're sitting on the S&P 500 about the 4,000 level, but you've got kind of the most bearish of forecasts out to the 3,400, which would be a significant sell-off from here. And then some really bullish ones. And this is to end year 2022. So we've only got around about 4 months to go, 3.5 now. But you've got some big banks like JP Morgan there. We've got a 4,800 price target on end year. I'd love to know your thoughts. Drop in a comment below. What did you make of the inflation print? But also, where do you think we finish this year? If you want to do another deep dive into another macroeconomic video, I'll leave a link to that up above. We also just talked about Elon Musk and Tesla's potential move into the lithium space. So check that video out after this one. Big thank you for joining us. For now, stay well and happy investing.